we talk about ESG investing by Degroof Petercam on global and European equities. My name is Andre Hertel and I'm the moderator of today's interview with Alex Rose. Hi, Alex.
Hi, hello, Andre.
Hi. Please introduce yourself, Alex, that the participants get an idea what is your function and your position at Petercam Asset Management at all.
Okay, good morning, everyone. My name is Alexander Rose. I am the CIO of Fundamental Equity at Degroof Petercam Asset Management. I have been with the firm over the last 15 years. And besides being in charge of managing fundamental equity, I'm also managing on a day-to-day basis. And I have been in charge, together with some other PMs, of managing the sustainable active global equity funds, of which is also the Europe Sustainable Code, because it's a similar process than our global sustainable fund. That will be the main purpose of our discussion today.
Thank you, Alex, for your introduction. So we talk about ESG, and as we know, Degroof Petercam is in this field for a long time. Maybe, Alex, you explain what have you done on the different steps and what is your approach concerning ESG investing?
So indeed, I think it's a fair statement that we have been involved in ESG investment for quite some time. We started in 2001. I was not there at the time, but obviously I have been there for quite some time. When you look at the main, let's say, steps in our journey over the last 20 years, I would highlight the fact that we have been signatory to the UN PRI since 2011. And we have the highest possible rating. We have launched, enriched the processes of our sustainable funds. Myself, I have been managing a dedicated food and ag fund for a number of years, and this is, let's say, for my own experience, been an important way of realizing that you should incorporate ESG in your investments, and this is clearly something we have done on a much higher level over the last couple 5-6 years, and this is has meant that we have grown our assets, be it in fully fledged sustainable funds or funds that embrace ESG integration quite substantially. Yeah, and obviously we continue on that journey and to be let's say, ahead of the pack in terms of ESG investments.
Okay, thanks. Concerning your mission, and everyone has a mission concerning ESG investing. Since when is this mission implemented? And what is currently the most influence factor on the 3 pillars and what you are focusing currently on?
Okay, so the mission statement, as you see it on the slide, has been explicitly formulated in 2016 after our yearly strategy ESG day, I would say. So this has been implemented, let's say, 4 or 5 years ago. It's a threefold mission, and I would say it's a balanced approach. It's like in the previous slide, we have sustainable approach, being active and research driven. This as well is a balanced approach. So the 2 first items are really about risk avoidance. The first one is in line with the UN Global Compact. The second one is avoid high controversies and do our work ourselves as well, have a clear opinion on several controversies that we deem not investable. And then the third pillar is more and more about opportunity setup. And I reckon when you look at the coming years with the EU regulation on disclosure, that opportunity pillar will probably become more important for a lot of asset managers, because you will have to demonstrate that a certain amount of your investments is really helping ESG challenges, and so coming with solutions. And this is really what the third pillar is about. But when it comes to investing, it's obviously a balanced approach, avoiding risks, because ESG risks can translate into financial risk, and trying to grasp ESG opportunities also helping you to generate alpha.
Okay. Concerning engagement with companies, how long do you do this in Degroof Petercam?
So engagement is part of our active, let's say, way of investing. You have the voting policy, which we have been doing for quite some years. Engagement is a kind of a buzzword, but it's something you do on a day-to-day basis when you have a dialogue with managements of companies. Because what we want to do is this company company managed for the long term, taking into account fundamental material KPIs and ESG KPIs. And so you can do the engagement in an informal way, having a discussion with management of the companies you have you have in the fund, or you are contemplating. This is something we have been doing as a fundamental equity investor over the last, let's say, 20 years, I would say. And then you have formal ways of engaging. And you can do that through sending letters, through your voting policy, to collaborative approaches. And this is clearly something that has been an important way of enriching our ESG approach. So really making sure that managements of companies, and even escalating to the chairman, are aware of ESG controversies, the risks, and really from our side, apprehend if the company is really aware of a controversy, is doing something about it, is trying to solve, or at least partially solve, a potential issue that pops up. So engagement has become indeed much more important in our, let's say, investment ESG processes.
Thanks. Concerning the team, Alex, how long do you work together? And maybe a further question, how is the interaction with the analysts and with the ESG team?
So that's a very important question. You have at many asset managers, you have the willingness to invest in ESG, proper analysis, and obviously have own buy-side analyst capability, and then obviously dedicated teams of PMs that you see here demonstrated on this slide. But what I think is really typical to the culture of DPAM, the Degroof Petercam Asset Management, is that there is a very close interaction between the different, let's say, teams within PMs, but also between PMs, analysts, and the ESG desk. Obviously, this has become a bit more difficult in a world where we have lesser, let's say, issues in terms of meeting each other. That is clearly something that we have obviously been dealing with. But if you look at the setup, it's not a silo approach. We are working closely together. There are around a bit more than 15 PMs. You see them on the slide deck. Some have been at the firm longer, and some have been more recent hires. When it comes to the, let's say, the two funds in question, World Sustainable and Europe Sustainable, they have been managed by the same team over the last 5 years. Okay. And then you have a buy-side analyst team of a bit more than 15 persons with a rather global reach. And then you have also 4 ESG analysts. So that's, I think, a sizable, let's say, human capital to continue to be at the forefront in terms of ESG investments.
Thanks. Concerning added value out of the ESG universe, I know that you are working together with Sustainalytics, MSCI, ESG-Research. and on the engagement side with Ibex Glass Lewis, and also for carbon footprint with TrueCost. How you use this research and how is this implemented to create your own decision-making process on ESG investing?
Yeah, so that's a very good question. On the right-hand side, you see a list of external partners. This is not an exhaustive list. There are other parties that have been added due to their niche expertise. When it comes to Sustainalytics and MSCI, I would say that we use them on quantitative grounds, so using their scoring mechanism, but apply it in a pragmatic and smart way, using their know-how in terms of following up controversies. That's a two, let's say, way of using that research on quantitative grounds. And then obviously on qualitative ESG analysis, we use their reports. They have more than 350 analysts combined, but it's similar to what I would say is sell side for us. You're using the arguments. You're trying to really have a good understanding yourself of what is material, but you are making your own opinion. You're not taking the conclusions for granted. It's the same like the target price for sell side. And then you have other, let's say, providers that help us on different grounds. iVox is obviously helping us on the voting policy, TrueCost on everything related to carbon. But as I said, the list is non-exhaustive. There are numerous other parties that help us. But it's clear that for us, that's an added value. But the bulk of our work, we do it by ourselves. The big team we have. And I mentioned you this previously, is the task is to integrate ESG analysis and fundamental analysis to come to, let's say, good portfolio constructions for the different funds we manage.
Okay. Now we are talking about the investment philosophy, which it's implemented for the European and the global equity portfolios. Can you give us a hint what is mean by active managed by Degroof Petercam, and also how do you define high conviction portfolios on your own?
Okay, so we are a long-only asset manager, and we have a long-term investment horizon. If you look at all the funds we manage, and it's not only sustainable funds, the average investment horizon is minimum 3 years, and I would say it's around 5 years. So the turnover is quite low. That being said, we follow up results of companies. We try to really have a good grasp on the strategy of a company, and so that means that you are going to enter into a let's say constructive dialogue with managements of companies to follow up the investment thesis, to see on fundamental grounds and on ESG grounds if the thesis is still valid. So you're going to be an active owner of your investments, not being activist, but because activist is rather short term. So an active owner with a long term, let's say, investment horizon in mind. Okay. So that is really, really critical. When it comes to convictions, most of our funds have obviously a performance indicator or a benchmark, if you like. We are not benchmark huggers. So if we are not convinced of an idea within a certain universe, we are not going to take it into account, even though it might be a big weight in the benchmark. So and the conviction happens on two levels, and you see this on the slide, top down and bottom up. So first the top down is ask yourself as an investor long term, which subsectors are important to be invested in for the long term? What are the secular trends? What can be disrupted? And so in all sectors, you will have subsectors that you want to avoid and subsectors that you want to be invested in. So the conviction is there. And then obviously on the bottom-up approach, you are going to compare companies between each other and prefer one to another because of governance reasons, because of fundamental reasons, because of other ESG considerations. And important to highlight, to stress that fundamental analysis and ESG analysis is done in combination at the top-down level, but also at the bottom-up level. And not only for sustainable funds, it's also done for, let's say, mainstream funds that integrate ESG in their analysis.
Okay. Concerning the products we want to talk about, can you give us a hint how you create your investment process coming up from a wide range of possible stocks to your high conviction portfolios, and what are the trigger points in your investment process which we are focusing on?
So this is an overview of the Europe Sustainable Fund screening process and the World Sustainable screening process. So obviously the first one the World Sustainable has a higher starting universe, around 30,000 listed stocks, while Europe it's 1/3 lower. We have obviously a liquidity threshold, which is lower for Europe than for the worldwide universe. And in the third step, we are going to apply the mission we talked about in the beginning. So you are going to avoid risks by banning companies that are not compliant with UN Global Compact, the four main principles, companies that have high controversies, and that is something where, as said, MSCI and Sustainalytics are important data providers. And you are going to exclude also companies that are in the first worst quartile in terms of ESG scores, and that's also data that is provided by MSCI and Sustainalytics, which gives you an investable universe of respectively 3,000 stocks and 1,100 stocks. For both funds, we have also voluntary exclusions on certain subsectors, for example, oil and gas, alcohol, which reduces a bit further the investable universe. But looking at combining the top-down and bottom-up approach, looking at the secular trends, I would say that for both funds, our investable universe, our real investable universe is much smaller. For World Sustainable, it's around 350 to 400 names. I would say that for Europe Sustainable, it's about half. And from there on, we do the deep dives, taking into account our radar screen, taking into account positioning in the value chain, but we will come to that, and construct portfolios that are, I would say, high conviction, well diversified, with around 50 names in each fund. And you see the key characteristics that all our companies exhibit in terms of either fundamental criteria or ESG criteria.
We highlighted position 3, and we will deep dive into this at this slide. Concerning the 3 pillars you are implementing for sustainable quantitative screenings, there's a normative screen, there are the controversy and the exclusion, and also the quantitative best-in-class approach. Can you give us a hint how many companies are excluded by these 3 pillars, and what have you divided, or what is your risk approach here, that you have left out companies who hurts maybe the performance in the past?
So the slide here is a reflection of let's say the threefold ESG step, excluding companies from our investable universe, what you have seen in the previous slide. So For example, for Europe Sustainable, you go in the second step to a third step by applying these exclusions, and you come to 3,000 names. For Europe Sustainable, it's around 1,100. When you look at the two first steps, risk, taking out risk in your investable universe, there is no, let's say, precise figure on how much you exclude, but I would say there are some overlaps between the two, because obviously companies that are not abiding to UN Global Compact most often have also a high controversy level. Okay. What is crucial to understand is that we always exclude controversy 5 level companies. Controversy 4 level companies are possible, but only are giving, let's say, a green light after thorough analysis done by our buy-side analyst or in combination with our ESG analyst, and then is potentially investable after, let's say, it has passed our responsible investment steering group, which decides on these matters. If you look at World Sustainable, there is only one controversy level 4 company in there. That's MasterCard.
Okay.
And you obviously exclude also, and this is on the slide, certain subsectors that are not deemed sustainable. Tobacco, defense, gambling, and so forth. And as I mentioned, we have also voluntary exclusions. We go a step further in this World Sustainable and Europe Sustainable Fund. And then the third step is really with a best-in-class approach, but pragmatic, and not excluding too much, but excluding, let's say, the worst in terms of management scores. It's a score which takes out the industry bias. We have reflected a lot on this, and we deem it important that companies are assessed on that score, on their ability to manage what they can manage, independent of the industry exposure. So that is important to highlight as well. And then obviously we have that fourth step, as I mentioned previously.
Yeah. Concerning, you mentioned how you work with the different subsector, and one of these subsectors are the electrical vehicle value chain, which has come up. The best example is Tesla here, but everything you have divided is in different steps, and what are the different trigger points concerning the value chain. Please explain, and what are the hints and pros and hiccups concerning these concerning the value chain.
Okay, so I mentioned the top-down approach is really ask yourself in what kind of secular trends you want to be invested. And often a trend is enabled by an innovation, often technology related. What is important to always have in mind is this trend going to be adopted? And often regulation is very important. So when it comes to EVs, it seems now quite obvious that penetration of electric vehicles will increase quite massively because of the EU Green Deal, because of consumer consciousness. We have been very positive on this trend already quite some time ago, I would say early on in that trend. But the adoption, let's say, argument is always a very important argument to take into account. The second step of that top-down approach is ask yourself, where do I want to be invested in the value chain of that trend? And you see the value chain of EVs represented here, from upstream, raw material companies, lithium, cobalt producers, and so forth, just to downstream part recycling. You mentioned Tesla. You see here on the slide deck that we deem Tesla on different grounds non-investable. It's only been recent that they have been started generating cash flows. I would say that certainly it's a very important company in the ability to adopt the EVs, but it's on different grounds for us, and also governance, obviously, and not a company we want to be invested in. We see more interesting, more defensive ways to capitalize on the secular trend of EVs. And some are highlighted here, and it's especially related to the powertrain. We have, for example, been very positive on power semiconductor companies. Why? Because when you go from a combustion automobile to a EV, you use 5 times more power semiconductors, because it's very important for your battery management and your energy efficiency, to increase range and to be able to adopt EVs in a more meaningful way. And so we see that as a good way to capitalize in a defensive way with companies that have already decent generation of cash flows, limited ESG risks, to capitalize on that move to EVs. And for example, Infineon has been a company we have had in the portfolios for quite some time. This is also a good example of a trend whereby you need to take into account ESG risks, and especially risk related to the sourcing of certain raw materials. And I would most highlight cobalt. There have been numerous issues related to child labor when it comes to sourcing cobalt in certain countries. And you have more and more regulation about this in the EU, and even in Germany. Obviously, there has been a regulation that is, let's say, started, and in EU that there is a directive that is contemplated, which will force more and more companies to look at, let's say, human rights in their supply chain. And this is a very good example why you should incorporate that in your thought analysis as well. So this is a good idea, illustration of how we work in these 2 first phases of the top-down approach. What trend you want to be invested in, and where in that value chain you want to be positioned. And often it's a company that enables the S-curve and the growth to inflict higher, and it's often technology related, which is the case for power semiconductors. But it's not only power semiconductors, but I take this example to make it a bit shorter.
Yeah. Concerning performance, and we see that both products are on the long term in the first percentile in this year, and on 1 year basis a little bit weaker. Maybe you give us a hint how the year were until today, respectively to the end of September, how you manage Corona, and what are the positives and negatives influences on the portfolio?
So you see both funds being compared to peers. That's a Morningstar peers analysis. Obviously, for World Sustainable, you have much higher number of competing funds in that category. It's a large cap categorization. It's close to 2,000 funds. For Europe Sustainable, it's a bit lower. And you're looking at any relevant investment horizon, I would say that we compare quite well to peers. You cannot go lower than first percentile, sorry. And year to date, we have, it's a bit weaker, but it's still, I think, a very good comparison versus peers. The question on the year-to-date performance and impact from COVID, both funds perform much better than their benchmark. Europe Sustainable is up positively, even year-to-date, but is also 16% ahead of the benchmark. Same for World Sustainable, up in positive territory and around 11% ahead of the benchmark. This year, I think it's important to highlight, has been a year where polarization has been huge. So not only between value and quality, and obviously both funds fall rather in the bucket of quality stocks, but as well in terms of COVID losers and COVID beneficiaries. And obviously what you see this year is that funds that have a very high tilt to IT or to healthcare outperform even more than these funds, Europe Sustainable, World Sustainable, that have the aim to be quite well diversified. And I think that's the major reason, although I don't see that as an issue at all, why Europe Sustainable and World Sustainable still compare very well to peers, but are not in the first percentile, because the polarization has been huge this year. You can see it also on a regional level, but it's especially true between sectors. And we have had some subsectors which up until the COVID crisis were, in our view, structural growth industries, but have had an impact from COVID. One I would mention is clearly everything related to travel, or away from home consumption. The away from home consumption up until the COVID has been growing much faster than home consumption, but obviously this has completely reversed since the COVID. So we had to adapt, and I would say that on average the turnover of the both funds have been higher this year than other years, because on the one side you adapt to the new situation and you try to make changes where needed, but on the other hand you also see some opportunities. Certainly in March, where we saw some companies being slashed because of short-term issues, and we picked them up at the moment where we thought it was vastly exaggerated.
Thanks, Alex. As you mentioned before, your alpha production works out for the European as also for the global product. Here is the European sustainable product, and we see that in the up markets you outperform more strong than in the down markets. What is this phenomenon or what is the theme here? Why is this, for example, we see in the fourth quartile in 2018 that you underperform, but in the up markets you are very strong, outperforming in all phases we are mentioned here.
So yeah, that's a good remark. There is a difference in terms of a slight difference in terms of behavior of both funds. You see that also on slide 12 in down markets or up markets. I would say that Europe Sustainable protects to the downside quite well, except, and it's also only minor, the period you mentioned, the fourth quartile of 2018, and participates a bit more to the upside when the market obviously goes up. I think this is related to the fact that we are talking about a smaller universe, so we are de facto having a lower active share.
Mm-hmm.
The fact is as well that the Europe Sustainable has more mid-cap exposure. I think that whenever there is turbulence, more liquid, larger cap names tend to do better. And I would say as well, and we will come to that, for example, so more defensive structural trends like medtech are less represented in Europe Sustainable than in the World Sustainable. It's about half.
Okay.
And for when you see at slide 12, it's a bit a different picture for World Sustainable, protecting more to the downside and let's say capitalizing to the upside, but not to the same extent as Europe Sustainable. And it's you have a bit higher large cap liquid names in there. It's as I mentioned, more medtech exposure. I would also mention the fact that we are not invested in FANG stocks in World Sustainable, which helps also when the market goes down and everything goes down in the same way. And the fact that World Sustainable has a higher emerging market exposure is helping also in terms of market turbulence, where we are invested in companies well-known, let's say, large cap companies with decent, let's say, exposure to emerging markets. It's on average 40%, helps as well, because not everything is correlated. And that's clearly the aim as well for World Sustainable, to be really defensive when markets go down. And I think we have done that quite well. For Europe Sustainable, it's a bit more difficult because the universe is also smaller.
Yeah. So you mentioned before the medtech, and maybe you can explain why you are concentrated on this sector in the healthcare sector, and how you divided it, and why you are so overrated in medtech.
So yeah, this is a very strong conviction of ours already for a number of years. So it's important to mention that we did not increase or initiated that strong conviction because of COVID. What is medtech about? So medtech, you have two different kind of companies. You have companies that are so-called life science companies that are providing instruments to labs to do either research on new potential drugs, new molecules, and that is obviously becoming more and more important, especially looking for new vaccines, but not only vaccines. There are numerous diseases that are still not dealt with, but also the instruments are used at labs to do testing of blood testing, other types of testing to see if obviously if there is someone if in a blood test someone has a particular disease, counting blood cells, red blood cells versus white blood cells. And then on the other hand, you have companies that provide medical tools for all sorts of end markets. For example, hearing aids, companies that are specialists in heart valves. For example, a company, this is on the slide, Boston Scientific is very well exposed to that. So this has been more impacted by COVID. What is interesting to note is that the life science companies providing, let's say, instruments, also provide reagents. Whenever you take a blood test, it's sent to a lab by your and it's analyzed by interacting your blood with reagents. And that model, which is the razor blade model, you're providing instrument, but you're providing also the reagents, gives you a very good visibility in terms of sales development, because often these companies have very high recurring revenues. Company Sysmex on the slide, which is the world leader in hematology, the counting of red blood cells, to make it short, has around 70% of recurring revenues. That is the fundamental picture. And these are companies generating consistent free cash flows, growing at very good levels, and growing at a very high clip in emerging markets. The likes of Thermo Fisher, Danaher, Sysmex are growing more than double digits in China, because China has an aging population and wants to take care more and more of dealing with diseases, helping its Asian society. But what is more important from an ESG perspective as well is that, and especially nowadays with the crisis, that healthcare costs as a percentage of GDP are getting out of control. So more and more has to be done to make the healthcare system still affordable and accessible to everyone. So a social issue is really core to the healthcare system. And what, for example, these life sciences companies enable is to enable automation of testing, do it in a much faster way, more cost efficient, and enabling, let's say, the substitution of much costlier, let's say, tests that are done developed in-house by the labs. So you see a very nice transition to, let's say, testing that is done in a less automated way to testing that is done in a more automated way. And the same is true for finding new drugs to cope with diseases that we have not been able to deal with yet. So these companies are really important in that whole framework and are, let's say, capitalizing on the value-based healthcare trend, which is not often the case or sometimes an issue for pharma companies, where you see more and more debate on lowering prices. And this has been ongoing for quite some time, but this will be obviously more and more a debate going forward with budgets getting out of control.
Okay.
I hope this is clear. And so for World Sustainable, that exposure is around 17%, while for Europe Sustainable, it's about half of that.
Yeah, as you mentioned before, finding good medtech companies in the European space is more difficult than on the global scene. Yeah.
Correct.
As you mentioned before, we talk about engagement. Give us a hint what you are doing there with your team, with Ms. Mortier and the other guys in the team. How is your approach here?
So you mentioned Ophélie Mortier, which is the head of the ESG desk, who is, let's say, steering engagement efforts we are contemplating or the ones that we are having. You see on this slide deck why we engage. It's related to different topics. It's often clarify concerns we might have with management because they don't disclose enough. So that's an easy one. If they engage with us, acknowledge the concern and disclose about it, then for us the engagement has been a fruitful engagement, but without any action and no divestment. And it's often a problem with mid caps that obviously disclose less than large cap companies.
Yeah.
But can also be an issue that is starting to pop up and that we deem worth monitoring, and we want to engage with the management of a company to really highlight the issue and see if the company is aware of it, is doing something about it, and is really trying to deal with it. As we speak, I would say that when you look at the two funds, Europe Sustainable and World Sustainable, over the last 1.5 years, we have had around 10 engagements. And that's most of them have been in a formal way, through letters. Yeah. But it can be also informal, first a conference call and then a follow-up with a mail. But in a formal way, it's often because the controversy is something we are, let's say, I would say, worried about to some extent, and want the management of the company to take action or at least acknowledge it. Yeah. With the whole COVID crisis, obviously, we have had some issues popping up. For example, companies that were not really proactive enough in terms of protecting their workforce. And this has been, for example, an issue to tackle with companies, or companies that are having issues with regard to human rights in the supply chain. This has been, for example, the reason why we have had an engagement with Nestlé. So I would say that there is no stated divestment policy beforehand. You look at it from a case-by-case basis, because obviously you want to have a constructive dialogue. But obviously, if the company is not reacting, you are going to, at some point, divest in a relatively short time period. If there is no really, let's say, reaction from the company, this is clear, then we are going to divest.
Yeah. So thank you very much, Alex, for your insight concerning Degroof Petercam Asset Management, especially for the two products you are managing. From my side, to sum it up, what we have heard today, we heard that Degroof Petercam managed in a high conviction way their portfolios on a long-term basis. They have implemented top-down and bottom-up approaches based on quantitative and qualitative filters. And as we heard, and they are one of these asset managers who are long in this field of ESG, they have implemented ESG on their own with their own team. Beside this, they have Sustainalytics and MSCI, the biggest player in ESG research, on board. They have also exposure to emerging markets and mid-cap in these different products, and they have generated alpha on the long and short term. So thank you very much, Alex, for your insights, and I wish you the best for the rest of the year, that the performance will be on the level as was before. Thank you for your participants and the audience for joining us today. Maybe we have this year more to speak about. The next will be ESG investing in emerging market debt with Stone Harbor. Thank you very much.
Thank you very much, André. And I'll keep, I would say, an important message, keep all safe, please.
Thanks, Alex.
Thank you.
You too. Bye.